All right, everyone. Special request by Mark Ezekiel. This is just a video to outline. If you have a property already with a ton of equity in it, and it could be your own house, it could be another investment property, whatever it might be. So it may be that you only have your own home and you're wondering how to get your next home and that type of thing. So here's my take on why you shouldn't be selling your properties. You should be keeping them and using them. Some will agree, some won't agree, but that's me, and I've done all right from it. So this is more so for the long-term investor. This is wealth creation, not get rich quick or lose money quick. This is keep your money and make more and do nothing for it, really. So let me show you. So I've done a spreadsheet here. Actually, let me share the screen first. Share. Cool. So let's say you have a property now that's, let's go to the bottom part here. Let's say your property is worth, I don't know, 350,000 in today's market. And we're assuming up here a 7% increase each year. That's year on year. And what I mean by that is if you have start with 350, by the end of the next 12 months, it would have gone up by 7%. And then the year after, it's 7% on that. The year after, it's 7% on 4K, which is 428. And by year 10, you can see here, it's more or less doubled in value. So 7% per year equals, with compound interest, to around about double over 10 years. Make sense? So if you have a property now that's worth 350, let's say you've just bought it, in 5 years' time, it'll be worth 490,000. Let me just see if I can make this, so I can take these lines out and we can see the whole lot. Can we do that? Yeah, let's take this one out too. And then you can see the whole screen. So there we go. So you get the years up here, the purchase, etc., monthly increase, so on and so forth. Now, if after 5 years you have 490,000, that will give you approximately £140,000 in equity. That's on top of, obviously, what you've put in as a deposit already. So you would probably have minimum 10% there. So you're going to have, you know, near on getting close to 190, 200,000 pounds in equity. Now, if you were to buy another property for the same value in your area, let's say, I don't know, you might say you want one next door, or you want one here or there, then you will have enough equity in 5 years' time in that property to self-fund that new property. Make sense? So you're not having to save up your own money. You're not having to scrimp and scrape. Your property is doing it for you. Yeah. Now, if we look at putting that up here, 350 grand, it's the same numbers, but it will show you that over the 10 years, you have an average increase of £5,738 per month in equity. Make sense? So some people say that, you know, let's say here it's 1,500 for that property in rent, or let's say it's 1,400 for that property in rent per month. And we're looking at putting that up by 5% each year. Again, it's year on year, so it will grow each every year. So 5% on that, 5% on that, 5% on that. It's exponential growth, compound interest, so on and so forth. So by the end of year 10, your rent will be at $2,172 per month. Now, a lot of people look at this in the buy-to-let world and think, if somebody says to you, what's your income? Wow, income, it's only £1,400 a month. And once I've taken out my costs, it's probably my mortgage. It might be £400 or £500 a month for something of that. It might be less, it might be more. And then you get to $2,000 here. So people think, oh, buy-to-let. Buy-to-let is not about the income. Buy-to-let is about the long-term capital growth. Almost £6,000 a month over 10 years for a £350,000 house. If it was a £200,000 house you're looking to buy, it's an average of 200. It's an average of £3,000 per month increase in your equity or growing your wealth. Yeah, and you can see that if you had 5 of those, let's say it's all worth $1 million. In 10 years' time, you're going to be a net millionaire if you were to sell them. All right, you're going to have to look at capital gains, speak to an accountant, ways around reducing it, and so on and so forth. But on £1 million home or a £1 million portfolio, that's £16,000 per month increase in your wealth. Now, all of this, £1 million portfolio in 5 years' time, 400,000, you can end up buying 3 of these with the equity. And then you add another, so that would be a 900, that'd be 1,000 and $1,050,000. And then in the next 5 years, you've added another $500,000 to your equity. And you've added another million, 2 million, should I say, to your entire equity by the end of that 10 years. So it's a long-term strategy. I'm hoping this makes sense. Now, if your portfolio in 10 years' time is now worth 2 million, whoops, you can then see that you are doubling each time your equity. So it'll be worth 2 million or 32 grand a month increase. Yeah. And your income on that 2 million portfolio could be, I don't know, five grand a month, might be a bit more. And you're getting that income each and every single month as well. You must always put up your rents each year and keep it consistent. The lowest you should be doing is 3%. Yeah, you want to keep your yield high. Now, the reason why this is currently at 5%, as in growing your portfolio income, is not to be greedy. It's because inflation is so high at the moment. You should keep your rental income as a minimum on the inflation number. If inflation is 3.1%, or if it's 2.5, 2.4%, you want to keep it as a minimum of 3%. Now, if it's going up, stupid values to like 8, 9%, 10% on inflation, you probably want to keep it at 7%. It just means that while inflation is high, it won't last forever. You are losing a bit of money. What do I mean by that? So inflation, it's if your money is making, if your portfolio is making 5% per annum and inflation is 7, you're losing 7%. You're losing 2%. 7 minus 5 is 2%. You're losing 2% on your money. Make sense? If inflation went to 10% and your portfolio is only making you 3%, you're losing 7% on your money. So your £100,000 at the moment will be worth £7,000 less by the end of the year. So you're losing money. And this is why, the main reason why people, when they invest and they put in 10 grand and they pull 3 grand out and they go, wow, I made 3 grand, I made a profit. But if they look at inflation and costs and that type of thing, chances are they've actually probably lost a grand or 2. Yeah, because that money could have been elsewhere making money. So you've got to keep an eye on inflation. You know, you hear stuff all the time, you know, inflation busting returns and that type of thing. All right. Property can be that. And at the moment it is, because we're, you know, 10, 12% at the moment per annum in growth. And that's just on your portfolio, on your long-term capital increases. All right. Your income's probably going to be a bit lower, unless, of course, you're doing service accommodation, HMO, or hotels, all right, where the yield is much higher. Now, this is all focused around money more so than property. Property is just the tool, the strategy to make us the money. But at the end of the day, this is all about money and how you make it. So just here, for example, if you spend £100,000 on a new car, how much is it worth in 10 years, and how much has it cost you in the devaluation of your money? So if your car is, you know, worth 100 grand today, you basically, you know, people like to buy flash cars, right? That's the way it is. You would actually go down in value, and in 10 years' time, it's going to be worth much less than half. Now, the car has cost you in total 131,125.98 pence, plus the loss of the 96,715 above. So in total, your loss is £227,000, not taking into account the cost of interest and maintenance and insurance, etc. What that's talking about is your 100 grand. So if you put in 100 grand here, and in 10 years' time, see if we can see it here, it's worth 196,000, right? Invest your £100,000 in property, in 10 years' time, it would be worth 196, plus or minus here or there, right? It's going to be worth a lot more if you had invested 2 years before coronavirus, because it's just gone through the roof. So it could be that it's worth 230, 240, 250. However, we'll work on the averages that property doubles on average roughly every 10 years over the past couple of centuries or so. So you've lost £96,715 already here by not investing that money, because you haven't grown it in property. So you've already lost that 96,000 because you didn't invest that money that you stuck onto the car. Right? Then you add the 100 grand, which is now worth probably nothing after 100 years, could be 10, could be 5, could be 20 grand. I don't know. You know, take a look at Mercedes, 100 grand Mercedes, you can now buy for £5,000 or £6,000. So you've lost all of that money too. Make sense? And then you add the compound interest that you've lost on that, the percentage each year. So that's gone as well. So it's the grand old story and statement that an asset is something that increases in value and gives you a return, an income. You can see your, you know, let's go back to the 350 and make it realistic for some of you. If this is your own house, you've made 5 grand a month, plus you've pulled in, you know, let's make this 1,500. Plus you've pulled in your 15, an average, you know, whatever the average is on that. The average is £1,887 per month. So an average income of 1,887 minus your costs, so it'd probably be worth at the end of it, you know, you're making £1 grand a month on that. And then you've got your increased equity. Now your increased equity is worth nothing to you unless you use that equity, that 350 grand ish, a bit less, 342 grand or whatever it is, unless you use that to buy more properties or more assets. Shares, stocks, equities, that type of thing can also be an asset that increases in value and provides an income by way of a dividend. However, it's obviously a lot more risky, because business can go out of business. Business can go out of business pretty much, you know, quicker than anything. However, if you invested in Disney, Apple, Tesla, those type of thing 5 years ago, you would have, I think, have 6-7 times your money plus an income. But I'm not telling you where to buy and what to buy. So hopefully that makes sense in why I like to keep properties, because it doesn't matter how old you are. I mean, if you're 80 years old, yeah, it's going to matter. If you're 70 years old, it's going to matter. If you're 60, not so much. If you're 50, it's okay. You're still going. Because whatever you have now, if you're 25, 35, 45 years old, you know, you can start a portfolio now with nothing. And in 5 years' time, you're going to have enough money to self-fund another buy-to-let. It may be, depending on where you buy it, you self-fund 2 buy-to-lets. But be careful not to buy in such a cheap area, because a cheap area will be better for income, but it will be lower on capital growth. So have a look at those areas too. I don't have time to go through all that and how to find your gold mine area, but have a look at that as well. If you need more information, let me know. This is the main reason why I hold on to property, so they can self-fund. And it doesn't have to be self-fund a buy-to-let. It could be self-fund a development, whatever it might be. All right. It could be fund stock market, any other asset that produces an income. We don't want liabilities like cars. If you want to start buying flash cars, then use the equity to put into a business and then claim that on tax through a business, but make sure it's an electric car. And pretty much, you know, the way prices are, fuel prices, that's going to happen pretty quick. So, all right, guys, hope that helps. And just stop share. And I'll send the recording out onto the group and share wherever you wish. Any questions? Spin back to me.